Bloomberg Audio Studios. Podcasts, radio, news.
Hello, it's Merryn Somerset Webb here. If you are a regular listener to the show, and I am sure you are, you'll already know, but this is just a reminder, I will be at the Fringe Festival in Edinburgh once again this year, hosting 4 very interesting conversations in Adam Smith's old home, Panmure House. I'll be there August the 17th to August the 20th. You can get your tickets by heading to the main Fringe website and searching for Merryn. We have some brilliant guests this year. Normally, I don't tell you who the guests are until, the absolute last minute, but I will reveal that we do have the marvellous Ed Conway this year. We've got the fantastic Russell Napier, and we have James Ferguson, who was on the podcast last week and has a lot more to say. And other guests I will reveal as the time gets closer, although I should tell you, of course, that John will be on one day. Now, back to our regular programming. 2 days, actually, John. Are you going to come on 2 days?
Yeah, unless you get anyone better.
That's what usually happens. Yeah, I guess someone better and chuck you off. Of course, that's not going to happen. Right. Back to our regular programming. This week on the show, I speak with Adam Rackley, who's the fund manager at Cape Wrath Capital, or rather the fund manager at Cape Wrath Capital, a UK equity boutique with a deep value investment philosophy. We like deep value. Dowgate Wealth integrated the Cape Wrath investment team late last year. We talked about all sorts of things, including why small caps, why the UK, and what he would buy if I wouldn't let him buy either of those things. But first, as always, senior reporter and author of Money Distilled newsletter, John Stappick is with me. John, hello.
Merryn, isn't it great to have the adults back in the room? I feel that's the traditional way to open a podcast at this point.
Yes, and isn't it great to live in a beacon of stability?
Oh, fantastic.
I know, that's the other thing we say. If I read one more article that starts with the UK as now a beacon of stability in a volatile world, I might get quite irritable, although I think I might have said it and possibly even have written it myself. And you know what's going to be awful? If it turns out that we are not a beacon of stability. What if this goes wrong? We're really bigging up the stability here, and I can't really see any reason why it would go drastically wrong in the short term, but nonetheless, it's going to be really, really embarrassing if something happens that makes the UK look not stable again.
That would be embarrassing. To be fair, expectations are very low, or have been.
No, they're not low. Expectations are very high for stability. Maybe not very high for other stuff, but very, very high for nothing happening that might scare the horses.
True.
Okay. Right.
Fingers crossed.
Fingers crossed. Everything crossed, because we don't want to have to start these podcasts with, oh my God, volatility. Don't want that. Right. You've been writing this week about the amount of tax that the government has managed to get from something they really shouldn't be able to get it from, right?
Yes. The interest on your savings. I really found this number quite shocking, simply because of the size of it. So before we do this, I just want to say, so for context, in 23-24 tax year, inheritance tax, which everyone hates and I understand why, raised about £7.5 billion for HMRC. And stamp duty on property raised about £11.5 billion. So that's the context for this number. So savings interest in 2021-22, when basically interest rates were at zero, and so no one was getting paid interest, and also the amount of interest you could earn before you paid income tax on it was higher. HMRC made $1.3 billion from tax on that income. This year,
the suspense is killing me, John. The suspense is literally killing me. Just give us the number.
Good.
Give us the number.
$10.4 billion this year. That's more than the inheritance tax take. Wow. It's almost as much as the property transaction tax take. It's a significant number. Yeah. And who's paying it?
And imagine, sorry, I'm interrupting. Sorry to interrupt, but imagine how many people don't know that they have to pay tax on the income from their savings because they haven't had to for so long. And people brought up in a very low income environment who may now suddenly have savings, because of course a lot of people have savings now. They may suddenly have savings on which tax should be paid and they're not aware of it. So I bet there's a bigger tax gap there than you'd expect as well.
There probably is. Stuff that people should be declaring on their self-assessment forms that they're maybe not.
Yeah, we don't have self-assessment forms.
Yeah, but the point is it's a lot of money. And given the sheer size of the allowances that we have to avoid paying this quite, above boardly, it just surprises me that there is this much going to HMRC And it feels like it's probably largely a voluntary tax or an apathy tax.
That is interesting, isn't it? Because you don't have to do this. You can put your money inside a SIP. You can put it inside an ISA. You can get one of the national savings accounts that does not attract tax, etc. There is absolutely no reason, unless you really have maxed all that stuff out. There's very little reason to have savings that attract tax.
No, and even then, if you've got so much money, you've been able to max that out, you can start looking at things that are even, wackier, like enterprise investment schemes and venture capital trusts, if you really do have that amount of money.
Yeah, if you've maxed all that out, what are you doing with your cash sitting around in a savings account at Barclays in the first place?
Exactly. In the weird kind of way, this tax just shouldn't exist. This tax take shouldn't exist. And so, get your finger out and sort out your personal finances if you're one of these people. And it is mostly additional rate taxpayers, by the way. So the vast majority of this is coming from people on the 45% tax band. So, go and have a look at where your money is, and if it's somewhere where it's paying that amount of tax on your interest income, then find something to do with it.
On the other hand, I suppose what you might say is if you don't pay tax this way, you're definitely going to pay it another way. You can not pay it on your interest, but something else is going to come. I'm quite interested in this idea, by the way, of means testing the state pension. This came up last week, and we haven't heard much more about it this week, but it seems like one of those things that you would constantly say if you're in the Treasury. Why don't we mean tax the state pension? Why don't we mean test the state pension? And then you look at it more closely and you think, well, this is really hard. This is really hard, because if you means test a state pension, what is it you means test? Do you look at just someone's pension income? So you look at their DB and their DC and you look at what they're getting from that? Or do you look at their income outside that? And if you start looking at their income outside their pension assets, then you have to look not just at the income that they have, but the assets that they have that could be used to generate income, right? So if you're going to look at someone's pension, and you say, well, I'm just looking at their income, and then everyone immediately shifts everything over into growth stock so they don't have an income, then you think, well, hang on, that's not okay. So now we need to tax it as though they were in dividend-producing stocks. No, that doesn't work. So how do you do it? So suddenly, what is it? Oh, it's a wealth tax. Because the only thing you can do is look at the absolute value of the potentially income-generating assets people have and tax on the base of that. I was thinking about this, so there's no way that you can means test the state pension without effectively introducing a wealth tax. And I give that to you, Rachel Reeves, for free.
I think that's a really good point, Lo. And I think actually there is something in that which points to the thing that you are always talking about, which is that rather than having inheritance tax, we should have a lifetime gift tax. And that sort of both encourages wealth transfers. You only get taxed whenever something's crystallised, so you don't have all the valuation guff happening. And it is a wealth tax, but it's a wealth tax that has got far fewer skewed incentives than anything else.
Yep, make it easy, make it easy,
Yeah.
make it easy. I mean, when we talk about growth, and this new government, and all credit to them for this, at least they talk about nothing but growth, how to generate growth. I'm not sure they're going about it the right way, but we'll find out that over the next couple of years. But they talk about it all the time. But one of the things that you and I often talk about, one of the things that would make it easier for the economy to grow would be for the tax system to be more simple. I mean, I had a little example myself this week. I won't bore you with the details, but a little tax thing, and the admin nearly defeated me. And I looked at it and I thought, I just don't think I'll bother with that. We won't do that thing again because I can't deal with the admin. Now, take that tiny little personal problem up to large companies, to small companies, to medium-sized companies, all the time, dealing with endless, relentless complications. If you just make it easier, I think you would find that growth would follow simplicity, and you might not need the endless parade of new institutions that we're hearing about at the moment, which moves me very nicely to the National Wealth Fund.
Yes.
Which is not really a national wealth fund, is it, John?
Well, no, because that would imply that we had some wealth in it as opposed to massive debts on the public balance sheet. So really, look, I mean, we've both been trying to work out what this is, but it's basically a seed capital fund for projects that the private sector is not investing in because they don't offer returns that match the risk. Yeah. And I mean, that's whatever kind of discussion we have about this, that's sort of the fundamental problem that you're going to come back to, is that no one is doing this stuff in the first place because it doesn't offer decent enough returns, and therefore it needs a public subsidy some way. That subsidy doesn't need to necessarily be directly financial, but it's, if it's in the form of a guarantee or in the form of, favoritizing legislation.
Yeah, or allowing you to raise capital at a lower rate or anything like that. Anything that takes some of the sting out of the risk, but however you cut it, if they call it a public-private partnership, it's a subsidy of some kind. And it talks about catalytic capital, which is a very nice phrase. I'm going to use it a lot these days. But it also talks about crowding in private investment.
Yes, that's a lovely phrase.
And this is an interesting phrase that I don't think we've really seen used in this kind of context before. If you're crowding in private investment, what are you doing?
I mean, I guess if you're crowding in, then you either have to have something extremely appealing for them to crowd into, or you need to be running behind them with a cattle prod to force them to crowd into the thing. So it's either a sold-out Taylor Swift concert or a Japanese subway train. Or a bit of both.
Very good, John. That's very good. Very good.
Thank you.
It feels to me a little more like a subway train.
Yeah, I didn't think it was going to be Swifty, unfortunately.
Well, it kind of depends on the projects, I bet. But I do worry that, when we talk about who are going to be the co-investors here, who is it going to be? That it might be our pension funds. And how does our pension fund money get from Aviva, Legal & General, whatever, into the National Wealth Fund? How does that work? What is the incentive, or what is the program? We don't know that yet. And hopefully we'll find that out over the next few weeks. But the key thing to remember is that one way or another, you'll be paying. Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb, and here is my conversation with Adam Rackley, fund manager with Cape Breath Capital, a UK equity boutique with deep value investment philosophy. Adam, thank you so much for joining us today. Very kind of you.
Thanks for having me.
Now, the last time we spoke, we were in Hay on Wye, right? At the Financial Festivals of Mistakes.
That's right, yeah, a lot of fun.
Yeah, and Adam, by the way, listeners, was extremely kind because I'd been on, how many panels had I been on by then? I paneled out.
A lot.
So I thought I'm taking audience members in for my next panel, and Adam was dragged from obscurity onto the stage. Well, not exactly obscurity, and we had a great conversation then, and we're going to have another one now, right?
We are, yeah. That was a lot of fun.
We are.
I enjoyed it.
It was. I'm sad we don't have a live audience today to heckle and ask questions, but that's something comments. So, Adam, let's start by talking about how you invest. You run a pretty focused fund that invests in UK small caps. So let's start by asking why the UK, why small caps? Why then, when you started the fund, and why now?
Sure. So I've always invested, or most of my career, I've been involved in small cap investing, either in the UK or kind of UK and Europe. I think small caps a really interesting market because it's generally less well covered than larger companies. Smaller companies generally have fewer analysts looking at them, fewer people interested in them, and that makes it a less efficient market. And so I think there's a bigger opportunity in small caps as an active manager to generate alpha. So that's kind of why small cap.
Is that more the case now than it was even a decade ago, and that regulatory change in the UK has meant that there are even fewer analysts following a lot of our small cap companies than there were 10, 15 years ago?
With the kind of whole unbundling thing, there's definitely less research coverage around than there was. And so there are, many reasonable size, well, for us, a reasonable sized company, kind of 100, 200 million pound companies that might have just a house broker covering them. And in those situations, the house broker, is working very closely with the management team. And so their forecasts may reflect more what the management team would like them to say than what, necessarily the kind of independent view of the analyst. So there's all sorts of things kind of going on there. But what it means is, yes, I think the coverage is probably not as good as it was 10 years ago. And that can create more opportunities for active.
So small caps make sense because of that reason, but why UK small caps?
So I think that there's plenty to go for in the UK, basically. I mean, I have looked at European small caps in the past. I think there is a benefit from operating kind of in your home market in terms of understanding the culture and the language. And I think, investing in Europe, some countries probably worse than others, there was always a sense that there was a local cabal of investors who probably had an edge versus us sitting in the UK, because they were that much closer to the management, or the information flow it was easier. So I think there is a benefit to investing in UK companies if you're sitting in the UK.
But there's also value in the UK.
A lot of value, yeah, huge amount of value in the UK. I mean, I've been investing in the UK for kind of 20 odd years. I've been running a kind of deep value strategy for 15 years or so. And I'd say this is, post-COVID, we are in a fantastic market for value in the UK, and particularly in smaller companies. Over the last 5 years, smaller companies in the UK and globally have underperformed their larger peers. And I think that's not surprising given the environment we've been in. If you're expecting a recession, then you don't invest in small caps, because generally they're kind of more volatile, more leveraged into economic growth. And in the last 5 years, we've had, the whopper of all recessions with COVID. In the UK, we had a short kind of technical recession at the end of last year. So it's not been a kind of fantastic economic environment, and that's reflected in the underperformance of small versus large. So I think over the last 5 years in the UK, small's probably underperformed large by about 20%. But if you look over kind of longer time frames, I mean, smaller companies generally have higher growth rates. And if you go back, say, over a 25-year time frame, there's significant outperformance of small versus large in the UK and globally. So, looking at some numbers in front of me, about 250% outperformance of UK small cap indices in the UK versus UK large cap indices. So I think there's a strong argument, a very compelling argument for holding smaller companies for the long term. If you've got a more tactical approach, then it will depend on your kind of outlook for the economic environment. But if there was a market I wanted to be in for my career, and I could choose small versus large, I'd choose small every day.
And do you think that that's still the case for the UK, given the regular outflows we've seen from the UK market, month after month after month for so many months now? It's getting ridiculous. So there are hints that we're beginning to see some domestic inflows again. But there are so many reasons that we keep given on this podcast and all over the place as to why the UK market is a continuing mess.
Yeah, I mean, I think as a value investor, one of the key things you believe in is mean reversion.
Yeah.
And the question always is when, and that's, the answer that you can rarely answer, provide with much accuracy. So, I think that these things go in cycles. And also, I mean, a bit more kind of anecdotally, the types of conversations I've been having, I think there's a lot more interest, a growing interest from outside of the UK in the UK market, and talking to global managers, for example, based in the US. There is a very kind of wariness around the valuations in the US market, and people look over to the UK, and it's extremely cheap relative to other markets, relative to its own history. And so if you do, believe in that mean reversion argument, then there's got to be a fantastic opportunity in the UK. And in terms of catalysts, I mean, obviously there's a lot of discussion about takeovers in the UK market, things very cheap, things getting taken private. There's a lot more buybacks happening in the UK, I've noticed, the last 6 to 12 months or so. More and more companies have been coming out buying back their own shares. So I think there are a few possible catalysts there, certainly, on a case-by-case basis.
Yeah, and it is those less the buybacks and more the takeovers that might attract international attention and make people think, well, if they're prepared to go into the UK and take over those companies, then I should go have a look at it.
Yeah, I think so.
Yeah. And what about politics? Does this idea that the UK is now a beacon of stability, as people keep saying, in a volatile world, is that a positive, or is that just a short-term nonsense?
Yeah, I think it's a positive. Look, is much going to change under a Labour government? I don't think a huge amount is going to change, but the more important than actually what changes is that perception of stability. And, the market hates uncertainty, loves certainty. And with the election out of the way and Labour with a decent majority, it feels like we're in for a period of stability and all sorts of people have got their kind of own gripes and their own expectations. But I think the key thing is that there is, a period of optimism and a sense of stability, and those are things that the market likes.
Yeah, and an awful lot of talk about going for growth and endless new organizations being set up to help us go for growth, most of which haven't quite got to grips with yet.
Yes, I mean, I doubt
But
really
the
that
feeling
makes
is
any
there, the
difference.
sense,
But
yeah.
yes, exactly.
The feeling
exactly.
that this would be a nice thing is there, and maybe there'll be some money, and maybe the National Wealth Fund really is a fund of some kind. We'll find out over time, won't we? But so there is a sense of optimism around that. So let's talk about how you invest, because you're a value investor, but you look for particular turning points. And then one of the things that jumped out to me in your literature is that the shorter the time you can hold a stock for, the better for you, which is not what most fund managers say to us. Most say to us, I'm in for the long term, I buy at the right price, and then I hold, and I'm not a trader, etc.
Yeah.
So as a phrase, it slightly jumps out from your fact sheet.
Absolutely. I mean, I think there's a lot of preconceptions out there about what the right way to invest in. And I think, it's all part of this kind of Warren Buffett school. So Warren Buffett said our favorite holding period is forever. And I think that's ingrained in the mindset of a lot of fund managers and a lot of people who allocate to fund managers, that is the right way to invest. So, that idea of Nick Train sitting in his library and making one investment decision a year, that kind of thing. And
I mean,
and
it has worked very well for Warren Buffett, by the way, and long term pretty well for Nick Train, although maybe not so well recently, but long term pretty well.
Yeah, there are many different investment approaches which can work fantastically well if applied with discipline, with a good process. So, I'm not saying that value is better than growth. I'm saying that you have to choose the investment style that best fits your personality, and then you need to go away and deliver a process and a philosophy around that to deliver returns. But I think that, there are a lot of rules of thumb. So, holding period, only buying quality, looking for low volatility, all these things are kind of really chime, I guess, if you're a quality growth investor. Because if you're a quality growth investor, you make one fantastic decision to buy that high quality business at the right price, and then your returns come from the compounded earnings growth of that business over time. Whereas as a value investor, you're more interested in buying at a discount to fair value and then selling at fair value. Valuation is absolutely key to your perspective and to your calculation. And so if we can achieve fair value in a shorter time period rather than a longer time period, then that is a better IRR. And we generate our returns by taking the profits we've made from selling at a discount to fair value, buying at a discount to fair value and selling at fair value and reinvesting that in the next opportunity. So that's how we achieve our returns rather than through the long-term compounded returns of the underlying company.
You see, you explain it like that, and it sounds like any good value investor should also be looking to have the shortest possible time as a holder, in that if you get the catalyst correct, then everything should happen very quickly. So if you turn into a long-term holder of your stocks, then you've got it wrong somewhere along the line. This should be quick.
I would say so, but I have some sympathy for other value investors who perhaps manage very large portfolios. So if you've got a 100 stock portfolio, it's impossible to turn that over, in 12 months. So our average holding period is 12 months, and with 20 to 25 holdings, we can realistically turn that portfolio over in 12 months. If you've got 100 holdings, there's just no way that you can have conviction enough companies to pursue that kind of strategy. So, I think what we do is quite a pure approach to it, but we're able to do that because we have, low capacity, a small number of holdings. And of course, the trade-off is that if you want to become fabulously wealthy as a fund manager, that's not the way to do it. You want to go out, you want to build a strategy that has huge capacity because you're making your money from the fees you charge your investors, and the more assets you manage, the higher those fees. But my view is that, if a manager gets wealthy, it should be from eating their own cooking rather than from the fees they charge their investors. And so that's how we've structured our fund.
Let's go back a little bit and talk about what fair value means to you. What makes a stock cheap and what makes it fair value? What are the signals you're using?
Yeah, so there's a bunch of different stuff that we're looking at when we're selecting our investment opportunities, and valuation is one piece of it. And then we're also thinking about the risks attached to that upside and the potential catalysts to achieve that upside. And the valuation itself is probably the most kind of quantitative part of it, insofar as we build out a model on every company that we invest in. We can do that because we've got a relatively small number of holdings. We generate some short-term earnings forecasts, and often the types of companies we invest in are in these turnaround situations or at trough earnings, and so we need to have a view on what the profile of an earnings recovery might look like. And then we apply those earnings forecasts across a variety of different valuation metrics. So we've got around 25 different valuation metrics in our model, and we'll select the ones that are most appropriate. And typically, I mean, if I look at our portfolio today, so the weighted average upside across the portfolio is around 77%. So that gives you an idea of what we're looking for in terms of upside. And the types of companies we invest in may often have fallen 70, 80, 90% from their recent highs. So typically, we're not looking for companies to regain their former glory, but we're looking for situations where other investors have become too pessimistic about what's happened around a company.
But it's very subjective, isn't it? In the end, as you say, you have 25 metrics and you choose the ones which are most appropriate at any one time. This is extremely subjective stuff.
Yeah, it is. Yeah. So, investing is the whole thing about investing being as much an art as a science. And, we have our process, and I think it's important to have a process to kind of keep you honest. But the fact is, the best computer that we have is the human brain, and the process will only ever be a kind of shadowy reflection of all the things that are happening behind the scenes in the brain. And the process should and does develop over time as you become more experienced as an investor and you develop your intuition, whilst also kind of working to guard you against your biases. So there's biases which try and trip you up. There's intuition which tries and help you make the right decisions, and the process kind of sits there as a bit of an arbiter between the two. So valuation is and all investing is an art as well as a science.
Okay, let's talk about some of the companies that you've got in the portfolio at the moment and what made them look like value to you. What's interesting, do you think?
Yeah, so we've recently took a position in the pub company Marston's. So Marston's owns around 1,300 pubs across the UK, and with a pub company, I mean, but pubs, it's a very liquid market insofar there's historically been quite a lot of M&A around listed pub companies, and then kind of individual pub companies are actively traded. So it's a very liquid market, so you can get a reasonable kind of view of what this pub portfolio is worth. And in the case of Marston's, if you look at the kind of tangible book value per share, so what the value of these properties is, basically, you get a figure of around 95 pence per share. And that kind of triangulates quite nicely against a takeover offer that Marston's had in 2021, so about 3 years ago, for 105 pence per share. And if you look at kind of transactions, it's normally kind of 1 to 1.1 times book value. So that kind of all makes sense, and stacks up quite nicely against Marston's current share price of around it's anywhere between kind of 30-35 pence a share over the last couple of weeks. So there's plenty of upside there. It's always interesting to think what the kind of alternative angles might be, and for us a nice angle was the fact that Marston still owns a 40% share of a brewing company JV with Carlsberg, Marston's brewing company. And we put in a value for that brewing business of anywhere between 30 and 50p. Actually, 2 days ago, Marston's announced they were going to sell the JV to Carlsberg for 33 pence per share. So that transaction is basically at the current share price of the business. The portfolio of pubs has some debt against it. And so even if you were to take that portfolio of pubs, say we're going to write the value down to zero, we're going to hand them all back to the banks, those 1,300 pubs, you can still get your money back purely through the sale of this brewery business. So we see a lot of value in Marston's and a couple 100% upside.
And how long? You say that your holding period is 12 months, right? Roughly, on average.
Yeah, I mean, there's a broad range around that.
How long are you prepared to wait? for a company to come to fair value? If you're sitting there and nothing happens with Marston's for 2 years, 3 years, 4 years, when do you call it a day with such a small portfolio?
If the thesis doesn't change, then we are prepared to be patient. Situations where we will recognize we've made a mistake and sell out would be if over time we see that assessment of fair value coming down. And there's a kind of death by 1,000 cuts every time there's an update. You kind of knock down your fair value by 10%, and after you've had 4 or 5 updates, suddenly perhaps the share price and the fair value moving closer together, but for all the wrong reasons. But if nothing changes and our fair value remains robust or even goes up, but the share price doesn't move, then usually we're happy to hold on to it. But it does give us pause for reflection. What is it that could it be that we've missed something here?
On your last fact sheet, Marston's was your second holding. Watkin Jones was your top holding. Is it still?
Yes, that's right. I know you've got a strong view on the student accommodation sector.
Yeah, I have.
Which is Watkin Jones is historically has been their core market.
Okay, tell me why I'm wrong then. Tell me why I'm wrong.
So Watkin Jones has got they're effectively a house builder crossed with a contractor. So their business model is to go out and get sites, typically in city centres, and then to find a partner, a investment firm, institutional investor, to provide the capital to build out that site. And so they'll kind of take their margin on sourcing the land. They'll take their margin on the construction phase, and then they'll also provide the ongoing maintenance, facilities management kind of service for that property going forwards if required. And historically, they've done very well during this kind of boom in purpose-built student accommodation. And they've also got, their purpose-built student accommodation business has been kind of stable to like in a kind of gradual decline over the last 7-8 years or so. What's been very fast growing has been their build-to-rent business. And essentially, these are very similar. It's the same skill set. It's often the same sites. It just depends on who the institutional investor is, who's kind of backing the project. Watkin Jones got hit particularly by the building safety regulations, so the kind of post-Grenfell building at height kind of cladding issues, because obviously they're building a lot of tall buildings in cities, and so that's had a significant impact on the valuation, on sentiment around the stock. But that's something that they've got cash to cover the provision. The provision seems to be fairly well figured out, and their remediation is kind of proceeding in line with plan according to the provisions that they've made.
And they wouldn't be dependent on them. I'm going back to student housing. They wouldn't be dependent on this market. It sounds like that model works.
Yeah, that's right. Not like the kind of Unite or whatever it might be, who are absolutely locked into that market. Now, I mean, these guys are absolutely kind of ambivalent about who the person is who's moving into that accommodation. But it's just, if you want to build lots of low cost flats in city centres, then these guys are the kind of go-to. And so I think that obviously we've spoken about politics and how much may or may not change, but there's certainly a lot of appetite and energy around hitting these house building targets again. And I think that that's got to be an opportunity for Watkin Jones, and a lot of the house builders started to recover around Q4 last year. You've seen a lot of them up 50-60% from their lows, and Watkin Jones really hasn't done a great deal over that time period.
You'd have thought, Adam, that the new government and all the talk about house building under this government and changes to planning, etc., would have been exactly the kind of thing that would have been your catalytic shift for Watkin Jones.
Yeah, I think you're right, Merryn. And actually, since the morning of when we all woke up with the new government, Watkin Jones' share price has started to move. So I think that could be something that's bringing more attention to the story.
Okay, we don't spend too much time on individual stocks, but just tell me, is there anything new in the portfolio that you're particularly interested in? Anything new come in recently?
Well, those are two of our recent holdings. I mean, there's plenty of stuff on my desk. Some of your listeners might be familiar with Yugov. So they've
I think
had
everyone's familiar with Yugov of the
everyone's
last couple of weeks, right?
yes. So they've had obviously had a kind of whopper profit warning, and so that's precisely the type of thing that falls into our screen, comes into our bucket, and so the work that that we then do is to work out, despite the share price declines, is it cheap? Because you can have companies that fall 80% and are actually not that cheap. And in the case of Yugov, actually it's probably not that cheap yet, despite the declines. And then we have to also have a think about the risk factors. So Yugov's got quite a lot of debt on the balance sheet, but having said that, they've been fantastically cash generative historically, so debt's probably not an issue. They've still got their kind of quality growth investor base on the shareholder register, and that's something that we look at, because often the best situations for us are where the quality growth people are having to sell out because it no longer fits their profile, fits their mandate, and the value investors are just starting to get interested in those situations. You've got a lot more sellers than buyers, and so for us that's the kind of classic capitulation event that we look for in terms of buying opportunities, where the outgoing investor might say, well, look, we recognize there is value here, but for emotional reasons or for reasons of our mandate or whatever it might be, we just have to get out of this at any price. And you have kind of indiscriminate selling at those lows.
And Adam, on a more macro level, so we're expecting interest rate cuts soon. That should be good across the board for small caps, right? Particularly for so that's good. Is there anything that you look at and you think, well, okay, the environment looks good, interest rates will fall, bit of stability in the UK, some signs from international investors that they might shift into UK small caps. This all looks great. Is there anything in your mind that you think could just derail that rather attractive story?
I think that the big car crashes are always the ones that you're not expecting. So look at COVID or whatever it might be, and small caps, they will always do better in an environment where there is that optimism, whereas there is that economic growth. So if there was something out of left field that came along and broke up that party, then I think that we would see small caps underperform large caps, and we would see probably some underperformance of value, because value stocks are often seen as lower quality than growth stocks, and in tough environments, it's the larger caps and it's the kind of more growthy stuff that outperforms, and the value stuff and the smaller stuff that's seen as riskier underperforms.
And you very obviously avoid anything in any of the overpriced tech sectors. So nothing AI in there. If there were, for example, a lack of balance in the US market, which is already at something even extreme, it gets even more extreme. You end up with a proper AI bubble, although you could argue it's definitely an AI bubble already. And then you end up with a crash in that sector. That would spread out across the board, wouldn't it?
Yeah, I think there would be ripple effects, yeah.
Which would leave you a wonderful opportunity to pick up some value in tech areas where you wouldn't have gone over the last few years.
Yeah, absolutely. I mean, we're pretty agnostic about the sector that we invest in, as long as we can understand it. And there's a company called Alpha Wave, for example, which has come across our screens, that serves that semiconductor market, which is kind of arguably been kind of sliding into value territory for kind of specific reasons. But if we can get our heads around the business model and the tech, then we're pretty agnostic about sector.
Okay, so you're not in any particular sector because you say there's things you don't understand. And a good value investor always says, I never invest in what I don't understand. So there must be areas where you can't go. There's certainly areas I can go on that basis.
So I mean, I guess there are some more specialist things like kind of some some biotech type stocks, perhaps. We for us, REITs were an area that we decided a few years ago we wanted to do a bit more work on. So my colleague and I went off and spent a bit of time on various kind of training courses and talking to real estate investors, so we could be comfortable that we had a way of kind of looking at REITs and analyzing those business models. So that for us was a sector that we brought within our area of competence. So yeah, it's a question of working out whether the opportunity's big enough to make it worth going out and spending time skilling up. Yeah.
Okay, what about, Adam, what about cryptocurrencies? Because at the end of this podcast, I always ask if someone over a 10-year period would hold gold or cryptocurrencies. And mostly people are ready for this one. And just to warn you, we do now have a couple of very enthusiastic Bitcoin people who follow us on Twitter and spend a lot of time explaining to me how stupid I am and how stupid all my guests are because they don't understand. And if only we would educate ourselves or read this or read that or read this or read this, then we would understand the amazing opportunity there. And of course, John and I always say it's not, we're not ideologically against cryptocurrencies or ideologically against Bitcoin. And we've both owned Bitcoin over the general cycles, etc. Although, of course, I keep losing my code, so I don't really count. Anyway, we're getting a lot of criticism for not understanding Bitcoin properly. So here's the question to you. What would it be over a 10-year period? Would it be Bitcoin or would it be gold? You can't have anything else. You can't have any of your small caps. You're not allowed to take any of this value in with you. You're only allowed one of these.
I would have gold.
You're doing this on purpose just to make me a hate target.
Sorry, Merryn. I totally get the argument for Bitcoin, and I think it's a kind of political kind of stance, isn't it, about manipulation of money supply, about trust of governments, and I think Bitcoin is, because of the limited supply, is if you're going to buy a cryptocurrency, it needs to be one with limited supply, basically. So Bitcoin stacks up on that basis. And I also buy the argument that that because of that limited supply, maybe you should just put a fraction of your net worth into Bitcoin because it could go exponential and and the hedge and all the rest of it. So I do get the kind of Bitcoin argument, but I guess if you go to a kind of extreme end of civilization kind of point, which is kind of where you get to if you believe that all currency is fiat currency is really worthless, then I think I would rather have something that I didn't need to be able to log into the internet to access.
It's interesting. That is where I always end up when I get into it. If gold and Bitcoin are both effectively designed for the same thing, designed to compensate you for the fact that fiat currencies are of no use to anybody over the long term, then you probably want the one that doesn't require an infrastructure around it to work.
I think so. A few gold bars in the basement. That's the way to go.
Have you got gold bars in your basement? I'm not going to tell anyone. I'm not going to tell anyone where you live. Adam, thank you so much for joining us today.
Thanks, Merryn.
Really fun. This episode was hosted by me, Merryn Somerset Webb. It was produced by Sam Asadi, production support and sound design by Moses and special thanks, of course, to Adam Rackley and, as ever, to John. One more thing I want to say to you this week. From September, John and I are going to go a little bit more personal finance. We are going to, once a week, take one personal finance topic, which we hope will be suggested to us by a listener, and discuss it for 10, 15 minutes, give our ideas on what you should do or what you might want to think about a subject, be that taxes, mortgages, savings, SIPs, ISAs, anything personal finance related. Write in, let us know what you want to hear about.